So we saw U.S. stocks higher earlier. They'd given up some of those gains. And let's have a look at oil as well. It did rally after falling sharply this morning. You can see oil now above 75 bucks. Our guest says that amid all this to and fro, the U.S. economy is not out of the woods. Let's get more from Jack Janasiewicz, portfolio manager and lead portfolio strategist at Natixis Investment Managers Solutions. Thank you very much indeed for joining us.
No, thanks for having me.
Start off with the Fed, if you would. The message seems to be that they are in no rush to cut interest rates.
Yeah, no rush. They certainly are still talking about that data dependency with a little bit of an emphasis on the uncertainty surrounding the potential for, the tariff pass through to hit the inflation side of the equation. But, from the market's perspective, you start to look at wage growth, which is actually growing at a slower pace than the Fed funds rate, which to us would imply that we're sufficiently tight from a monetary policy perspective. As the labor market continues to slow, which is what we're seeing, the Fed might actually be a little bit behind the curve, and as a result, might be chasing a slowing labor market and really too late.
Sorry, give us that again. That they may have left cuts too late. You mean, or what do you mean?
Well, I think there's a risk that we're sufficiently tight. We're already seeing signs that the labor market is softening right now. You're getting some squishier economic data, and if the Fed is still waiting for those signs to manifest in slower inflation, they might be a little bit late to the game with the labor market really slowing already. So the risk is that they're technically behind the curve.
What's your broad strategy right now when it comes to equities? Are you underweight stocks in the U.S. market, for example?
So we've got a slight overall underweight within regards to the traditional 60-40 portfolio, but we're still leaning into U.S. large cap because we're still favoring sort of up in quality. But again, when we start talking about that slowing backdrop, the simple panacea for all this is rate cuts in here. So any sort of slowing in the growth backdrop could initially be taken as the potential for slipping into a recession. That growth scare could set in, and we'd be actually looking, I think, to start to add risk at that point, because that's probably going to trigger the Fed to have a pivot and actually move to a much more dovish backdrop.
And the backdrop here, you touched on this already, the U.S. economy, you think, is slowing in an orderly fashion. I don't think you think it's headed for the wall.
No, not at all. And I think even in our bear case scenario, which would be for a modest recession, when we start to look at things like the household balance sheet and the corporate balance sheet, we're really in still pretty good shape. There's not a ton of leverage on either side of that. And that excess leverage tends to be what really precipitates a sharper downturn. So we just don't see that. And as a result, any sort of weakness going forward in our worst case scenario would probably be a mild recession, which is something I think you could still see positive earnings growth, and you don't have to have a massive correction on the equity side.
You do note U.S. capitalist dynamism, and companies, when it comes to tariffs, for example, companies have shown in history that they can adapt over to given time.
Yeah, and I think that's fair, right? As long as corporate America knows the rules of the game. And so in that case, what are we talking about with regard to Fed policy, and more specifically with the Trump administration policy on tariffs? Give them the rules of the game, and they'll figure out how to make money in here. So I think that's one of the advantages that we're seeing with a dynamic labor market and a dynamic economy here in the United States, which gives us a little bit of leg up over everybody else.
Let's put up a 5-year chart for the NASDAQ 100 as a proxy for the Mag 7 stocks. What is your take on those? You reckon that in some ways the multiples are looking more attractive?
Sure, and we've seen certainly a repricing, especially on the Mag 7 backdrop. I think the concern going forward with the market has always been that those earnings growth estimates continue to converge to the broader 493, so to speak. But, when we start to pay attention to that evolution, that convergence seems to be getting pushed out quarter after quarter. And so you're still looking at decent growth rates from the Mag 7. Mm-hmm. But I think the bigger picture there is it's still a tech story. The tech earnings backdrop is still looking at double-digit growth. You're looking at earnings at revisions pushing higher, not necessarily have to be driven by the Mag 7, but that broad tech space is still going to be the leadership going forward. And as a result, we still think that's where you want to be having a significant portion of your allocation within the equity bucket, still to tech.
We've heard this narrative that investors are cutting their exposure to the U.S. generally because of unpredictability in the White House. U.S. dollar, excuse me. Last week hit its lowest since 2022. It is up a bit since then. But you think betting against the US has become something of a crowded trade?
It's a tough one, and I think a lot of the narrative in the price action sort of come together there. But when you sort of peel back the layers, I think more of that is simply tech had been the trade over the last few years, the AI revolution. So that's going to really focus on the U.S. tech backdrop. So you're going to see portfolios allocating to that trade with the outperformance that we've seen from U.S. equities. That overweight in global portfolios probably grew. And so given this uncertainty with trade backdrop here in the United States, it's not surprising. Yeah, maybe you take a little bit of chips off the table, you rebalance back to where you were. That rebalance might look like portfolio shifts away, the end of U.S. exceptionals and that sort of thing. But, I think when we start to peel back the layers there, you're still going to have allocations coming back to the U.S. equities, plain and simple.
And just on gold, speaking of crowded trades, a lot of people saying gold, how would you bet against it? People worried about the U.S. government debt load, for example. What's your broad feeling on gold?
I think those, again, it's a narrative that fits with concerns around the deficit, concerns about having to finance that, the debt issuance, that sort of thing. But I think when you just simply step back and look at supply and demand, right, we've seen the dollar being weaponized from a political perspective. And I think you're going to continue to see a lot of these global central banks, especially guys like Russia and China, continuing to try to diversify away from the dollar. And that means you're going to see probably a bigger allocation to gold. And that continues at the margin to provide a bid. And so as a result, we wouldn't be surprised if you continue to see a slow grind higher in the price of gold.